Hello, this is Cryptolyze. I hope you are well on this Saturday, October 7, 2023. It is with pleasure that I meet you today to talk crypto, to talk BTC, and especially to talk bull run. Because today we are going to ask ourselves the following question: is if there is no soft landing, if there is a hard landing, can it still be there a bull run? Do our forecasts still end 2024 hold? Will it be a classic bull run behind it? Will we have a normal schematic? Will the idea of having a pivot from the Fed and a potential crisis in the USA impact the notion of bull run in temporality and even in its existence? And we'll start right away. Before starting, a quick reminder: you have the possibility of financing an educational course, therefore training of more than 60 hours in which you will see crypto, blockchain, trading, technical analysis, investment through videos, guides, more than 130 videos, all for free. If you want to get it financed, it's here. I will put the link in the comments. You can, by making a deposit of 500 euros on our partner using its platform, have the training fully financed. Everything is in comments and descriptions, and we return to the news, which is rather harmful. It's one of the reasons why I'm making this video today, because we have news, which, that's it. We had red bars. We consider that potentially at the soft landing that is no longer going to be the case. This is no longer possible. We are going to go into a form of hard landing. The fact of having a massive sale of bonds is a truly catastrophic crisis for the USA, and that overall it is a bit like end of the world. It's a bit like the communication sets that we had this week. And I want to come back to this and explain to you a little bit why we have this type of communication. And for me, we're not necessarily going to get into a hard landing, and in any case, it won't actually prevent the bull run. I'll explain everything to you. Now, already everything will start from a crucial point, which will be oil, okay? We recall that inflation is relatively high now, mainly because of oil. We have behind the body, which is still relatively low, which we managed to contain, which is still a little high, but which is rather classic. The 2% target is still relatively close compared to the inflationary framework that we have. And even at a basic level, it is completely classic to say that, okay, we can stay above 2%. We have already done it several times without necessarily having rates that are excessive. And so for me, we are in this process where everything is linked to oil, and oil, as a reminder, is a political weapon in which it will oscillate between Saudi Arabia, the USA, Russia, and even in general, we will say the BRICS plus, because now it is more than simply the BRICS. It is the BRICS plus, and in which we face the United States. And we find ourselves in a form of range, which is a bit like the ring in which we are going to have a political fight, which is going to be between $93 and, come on, we're going to say a little higher. We are going to say $70. I would be surprised if we really saw it that low, or it will just be a strand that will be swallowed instantly. So it will, in fact, be an oscillation in these areas. So we will have overall inflation, which will be linked to that. We just have to understand a cycle that is being put in place. And it is very important because behind it, we are going to have an impact at the BTC level, because clearly the BTC, we are in this process where we have here ourselves, we're actually stuck in a cycle where we have the big support zone here that's being held. By the top of the previous cycle, where we have here 20,000, we will say 19,800 and here 17,300, in which we made deviations here. We went to look for liquidity in everything, and we left again above. But overall, for me, it is this low zone and this high zone, which is the representation of the first acceleration of the support, which served to maintain the price of BTC while we had the China ban at that time. And overall, it is these two supports, this resistance and this support, which will fight, which in fact form us a range. And it's exactly the same idea, that is to say that we are in this representation here of ranging and lateralization on elements which are relatively key, which are relatively strong, one through here, oil, which is the fuel of the economy, which is what the economy is going to pull towards. If there is no oil, there is no growth. If there is no growth, there is no stock valuation, there is no point in having prolonged growth. And BTC, if we are not in something which is inflationary, or at least which is expansionary, in which we will have volatility, well, that means that we are not actually attractive for investors. So we are in the same process a little bit where we are stuck in a very strong vice in which here it will play on inflation. Inflation in itself will play on the monetary policies of the USA and will in fact lead to structural valorization. And there we are going to look, really keep that in mind because we're going to really go into detail. We're going to try to project ourselves a little bit into temporality with, for me, I will always see this real fall and a consolidation of the oil. Over the months that come in this area, around $80 or even why not a little bit lower, and look for $75 here in this area before being able to start again on the rise, okay? In all cases, I think that we will not stay in a classic zone, but I think that we can break this part there, whether it is zoned below or whether it is zoned above. We are really in this approach where I think that we will have a stabilization of oil. It also means a stabilization of inflation, a continuation of the reduction in inflation thanks mainly to the delay in oil. So we have something that will be rather positive, and what is impressive is that we are starting to have that while we have very strong communication saying that it is very negative and that it is now that it's negative. Whereas when we look at what happened over the last 3 days of this weekend, we had when even something that was quite positive, we did a test on our retest and we accelerated upwards. We are on the S&P 500. And for me, we remain in this approach where we are going to potentially retest here, this big retest that we have. 4,435. Here we are really in this idea where we are in a breathing phase, thanks mainly to the oil, which is being established, and to communication, which is rather negative. So here we have a negative communication, which has been made here saying that this is the end. We are going to sink in, and what will we see? We see a reaction too. People sold, it was bought in particular by the big players. And behind that, we will go higher to do a sell-off. And there we will have a communication saying that overall everything is fine, that the recession, all things considered, we will start with a worthy surplus. There are no worries, and we will have bearish continuity, which is rather classic. This time, so I see more of a temporality or even a delay in this area. Why not for a certain time during October and until potentially mid-November with an SP 500, which will stabilize. Here we are in 3 months, therefore in quarterly, to be able to have good visibility. We see that we had a first bearish impulse, a retracement, and here we are rather in a retracement phase. I think that we will trace lower, and which will in fact be our last bearish action, and which will happen for me rather Q1 2024, in which we will have a very strong bearish breakout, in which we will have a valuation of a certain number of points. Because you have to understand that there are several things, there are several elements. We have one, the regularization here of government rates, which is being carried out. We see that the gap between the different rates is narrowing and decreasing. To compress, which is rather normal, so that implies that we could be in a tilting zone, something that we generally expect. We can clearly see a compression before having the tilting behind. So it is a little bit of what we expected here, which we didn't get. We got a little bit, but it's not exactly what we expected. We could be good with this approach. We could have a breather. Why is it important? Because here we have to understand that we are in a process where it is not interesting to expose ourselves to risk. Because we are on positive real rates, this implies that when we take the rate offered for holding American Treasury bonds versus inflation, we make money. So what is the point of seeking risk, therefore, through stocks, through BTC, when we have yield offered almost free, which is given to the level of U.S. bands? So we are really in this idea where, moreover, it pushes the dollar upwards because we are in a situation where it is interesting to hold U.S. bonds, and to hold U.S. bonds, we hold the dollar. That is completely logical. So we have an attraction of the dollar, which is given as long as we are in real rates, and something which will not change until we have an inversion of the curve, which will return to zero, an inversion which I spoke to you about regularly, which is the gap between 2 years and 10 years. So overall, it is more profitable to have 10 years than 2 years. So as long as that, it will not go back to zero. And as long as behind, the rates of the Fed here will not decrease, okay? So as long as we do not have a reduction in government rates, and precisely driven by the Fed rates. So moreover, we remained on rates which are relatively fixed. All right, so we did not increase at the last one, yet we have an increase here in bond yield. For what? Well, quite simply because we have a growing demand. Why do we have growing demand? Because everyone understood that we were part of a political idea of remaining safe. A ceiling, and therefore we are in the implementation of the ceiling. We will no longer have an increase in rates or even a large maximum, but the probability decreases systematically. We are in something where we will remain on a rate which will stay like that before making the pivot. So that means that it is interesting to be exposed to American debt now. And therefore, at that time, we will sell the previous one to buy new one. So we have this sell-off, which is being carried out. And so when we have the sell-off of the current bands, what do we have? We have an increase in the rate, which is structurally classic, okay? And so there, it makes sense because people are anticipating the fact that rates will decrease. Rates will decrease. What's happening? At that point, the monetary attractiveness of the bonds will increase because it will be much more attractive to hold bonds that were purchased at periods of rates that are high than bonds that were purchased in these areas. There, which is rather classic. There, you have vouchers that pay you 3-5%. There, you have vouchers that pay you 1%. Well, it's more interesting to have a ticket that pays you 5.1 all year round. You understand the process well. And so here we are in this dynamic where we talk about being afraid at the sell-off level here. So we are going to reverse this notion of sell-off because we must understand that many banks, and in particular the American banking system, have American Treasury bonds. But suddenly these are assets in which the quotation will decrease, therefore will certainly be below their profitability level. This has already been the case for some time, but here it is even more the case. It is in note, and therefore we could end up with banks which lack liquidity during a bank run, as we experienced with SVB, or other banks which were saved at the last minute. So we are in this idea of saying, okay, potentially we are in a saturation zone. And what is going to happen overall at QOwn? When we are going to have an S&P 500, which is going to sink, when we're going to have bounds, which are going to continue either to stabilize or to sink, and we potentially have a risk of collapse of the U.S. monetary system. All of this would be sprinkled with potentially inflation, which would be managed mainly through the reduction and stabilization of oil. We will have a reduction in rates at the Fed level, and therefore we will return to no longer a real rate and a neutral rate. What does that imply? This implies that at that moment we will see an influx of liquidity in the SPY 500 because we will seek yield. Also understand that the notion of theme is classic. That is to say that here we are in an end year. End of year, people must seek return, must seek their bonuses. Traders, this is what they will do. They will try to seek volatility. They will try to look for where there is yield to structure. In fact, they offer and respond to their customers. Either they lose customers or they face penalties if they do not, in fact, have the minimum assured return. So we find ourselves in something where we are going to look for short-term solutions and then make the transition at the beginning of next year to prepare for what comes next. And this is exactly where we are going to find ourselves in a transfer of liquidity running 2024, which will move from bonds to U.S. bonds, with in particular the establishment of the Fed pivot, which will be prepared by the market, of course, and anticipated by the market partially. Although the anticipation in itself, I find that it is a little stunted, because when we look here at the notion of bankruptcy and therefore the notion of default and therefore a filing for bankruptcy of U.S. companies, therefore, which is the curve here that we see in blue, we see that it is in the process of being the increase. And the curve here in purple is the curve of the Fed's interest rate increase. We see that both overall there is a lag, yes, but which is not a monstrous lag either. When we look at the gap between the two, what do we have? 2, 3, what do we have? 3 quarters, 2 quarters, we have 6 months, okay? We have a 6-month gap, an injection, in fact, a transition from one to the other. So that implies that we will continue to increase and then we will decrease. We will then have a decrease. So we will have something which will be like this, hop, an increase, then after a decrease, and there we will have the installation of the pivot and a descent which will take place before, and therefore we will in fact have the installation, perhaps hop of something, which will be more like this. It's rather classic. And that this sign of temporality implies that we will arrive 6 months after QOwn. We will generally arrive at Q4 2024. And this is where we are going to come back a little bit to BTC. We remembered everything we said to project ourselves onto that. Overall, what do I see in relation to this? So already there is one element which is concrete. It is that the bar of 25,000 is really very hard. It is really very, very, very hard to maintain at the same time, which is logically, it is approximately the middle of the range that we have drawn there in front of us. But what is also important is that we have very strong resilience of BTC compared to the SP 500. Clearly, in my approach, I thought very strongly that when we were going to see this bearish breakout here in this zone, that we were going to have a BTC which was really going to hit the 25,000 hard, or even fetch the 23,000 in that period, to then consolidate, retype on the 25,000, and then to share out. So something that could be schematized in this way at the level of BTC, having had this breakout, this retest, and generally consolidating here, or even retesting the 20,000 a little lower and then leaving again, all right? But in this case, that is not the case. We find ourselves in a process where BTC is resilient, or even very resilient compared to that, which is mainly linked to the real rate, which is normal because there is no incentive to take risk at the BTC level, because we directly have returns which are offered by the American Treasury. So we are in this idea where, for me, we are going to change our tune a little bit, and you will understand why. We are in this representation where we are potentially going to look a little higher. Are we going to retest the 30,000 here? Are we going to go get the 33,000? Are we going to make a diversion? That is to say, we are going to do a little bit like here we knew my versions at the top. That is to say, an acceleration also by breathing and descent, in which here we could have news of the ETF, which appears QON 2024, with an acceleration in the price of the SP 500 upwards. With rather good news, or in any case, a general delay, therefore something which could have a stronger breathing before having this very strong crisis announcement, which would take place Q1 2024, with a breakout which could take place here to retest the lower part and then start again upwards. Remember that QON is generally from January 2023 to April 2023. And so at that time, we would find ourselves in this zone at the April level before the implementation of halving, in which we would have a form of grinding which would take place, which we know very well that we have already experienced before having the very strong acceleration that we would have bull run. So for me, end of Q4 2024, in which we would have an acceleration with the rupture and the consolidation above the 31,000, 32,000, in which here we would return above this whole area, which would allow us to consolidate and start to rise again very strongly. And that's where we would see this type of very strong candle, okay? It's a bit the same principle. We can see that we have a very strong zone, which is noted here. We do a first retest, we break again, we make the break, and when the break occurs, that's where we have acceleration. So for me, we are really in this idea of representation, and which is rather logical, in fact, compared to what we are seeing at the macro level. In any case, the representation that I have of it, C, is entirely logical in terms of temporality. So we would be in something which would be coherent. That is to say that here we would have an end of year, which would be rather in the green in terms of BTC and cryptos, rather BTC in the general world. A QON, which would be rather bearish, in which we will have interesting buying opportunities, and we will have to buy the fear in this area. And overall, after accepting the grinding, which risks being long, in which we will say, no, it's the recession, it's bad, it cannot go up, et cetera, and yet we will see a BTC which will buy back all the SLs and which will snatch all the SLs to then have here the sell-off zone, and then the very strong acceleration, which we will experience at the end of 2020 oven. That's a bit of the idea I have there, because in any case, in terms of rates, there are no 36 solutions at any given moment. Inflation, if it returns and we manage to control this part, which is rather geopolitical in terms of oil, clearly inflation will be able to stabilize. It will be able to stabilize around 5%. And it just has to be fast enough to avoid ending up in here, there, an increase in bunker upcycle, which would be colossal, of that style. However, if we have a very strong acceleration, which is much faster than the passage here at the level of the bearish implementation, we will be in a problem which will be very strong. But when we look, here we are really in something that is different compared to 2006, 2007, 2008, in which we had an increase in rates, which was still relatively long, an implementation of pivot, and then we had the increase in bankruptcy filings that took place. We also pay attention to employment. Well, the unemployment rate in any case is increasing slightly in the USA, so we know that we have an impact which is being made. But this, is rather logical. If we look at the bankruptcy filings and we look at the unemployment rate, it is correlated, which is at the same time normal. Although there is a part of the bankruptcy filings which is linked to small structures which were launched throughout this part. In fact, where yes, the COVID led to quite a few creations of small structures, and which are in the process of having defects now. But we are in a schema which is different, because we do not have a movement which is really accelerating like that. We rather really have a form of rounding which is here, and this rounding anticipated a little bit the increase in rates here, but which is rather also classic because we had a structural defect of infrastructure, routing capabilities, etc. So for me, we are in this idea where we will have the plateau, we will have the descent, we will have an increase, and then a descent at the level of the cryptic blocks, something which will self-regulate for a while, because for me it's about cycles, and the cycles get closer and closer until they burst. Will we see the explosion this cycle? I don't think so. We are in something that is rather solid because we have an economy that is relatively solid. So those who think that it takes a long time to enter the economy, here we have proof that this is not the case. There we see that this is the proof that this is not the case. We have 6 months apart. We are not at 12 minus 18 months. Here we have 6 months apart between the two. And therefore, I think that the acceleration that we see there, we will perhaps have an acceleration fast enough to retest this part before being able to make a break and a breath. And this is where it will normally be anticipated, because we will not stay on palace, which are very long either. Here we had a palace which was relatively long. and in which we were forced to let go because there had been no choice. We were almost at a plateau of 1 year, and at that time we were forced to let go because precisely we had an increase here in inflation. We had an increase in unemployment. We had an increase in the possibility of a financial crash, which was also linked to financial products, which were really bad, okay? We recall the problems. That was it. So here we are, not in this same approach. We are in a fight against inflation, and we see that the fight against inflation can be controlled as long as we can control oil. Now we have to finish managing this oil struggle, which is clearly, let's not kid ourselves, a political struggle. And in 2024, speaking of politics, we also have a potential U.S. political change in which we could see the Republicans who return above, therefore, which would be positive for cryptos, but also with an international approach, which would be totally different from what we currently know, and which could also influence what do we remember. Oil, because it is a political weapon, and therefore inevitably we will have an influence depending on who runs the country in the USA, and the impact is likely to be relatively strong. That is why we must monitor all these elements. I will end by summarizing a little bit at the level of BTC. Clearly for me, we will always find ourselves in this zone of lethargy, which is rather classic at the end of the year, in which we risk perhaps having a little bit of breakout to go a little higher. But in all cases, we risk finding ourselves on a breakout of the 25,000 to have a breather before the halving, to then allow us to have a structured and structural retracement at the halving level and that east. The general idea, because in all cases we have several elements which are endogenous, which are waiting, and we know that we will not have them before precisely this end. Clearly I do not see ASEC validating the ETFs in January. It will certainly be on the razor's edge. So really at the end, so that is to say March, April, once again, when we look at the time frames, we are really in this idea, in this situation here. And that could be an element to give an upward acceleration to BTC, but in the meantime, we will inevitably have a breakout because we no longer have liquidity, which is injected from the outside. And if we ever have really bad news that will arrive at a given moment, we will have a sell-off that will take place. In any case, we see very clearly that the movements which have been carried out recently, if you follow the daily newspapers, you know, are movements which are linked to the perpetual. So these are not spot movements. So that implies that we are going to look for volatility to create movement, to create volatility for itself, to create movement, and so on. Except that we know very good that it doesn't hold when we have accelerations like that. Here, these are spot actions and reactions carried by perpetual at the beginning, then transformed into spot, and there this is not the case. This is not what we see here in this zone, so that is why we take a little step back and breathe. I hope you liked this video. If so, don't forget to leave me a like and a comment. It always makes me very happy, and we'll see you tomorrow for a new video.